Good morning, everyone. This is Curtis Hawks with Insurance Agency Marketing Services, and we've got a very timely and important topic that we're going to be discussing today. And we're actually kicking off our three-part IUL Advantage sales series. And so, the reason that we're doing this is there's a lot of I think opportunity in the Indexed Universal Life space right now with the direction of the products, and we'll talk about this a little bit over the course of this presentation, but legislation that was passed at the end of December. And so we felt like it was an important thing to uh, kind of take a deep dive and make sure everybody understands what's going on and make sure that they're capitalizing on the opportunity. So before we get into that, I did want to take a couple of minutes and chat a little bit about some of the additional ways that IAMS is here to support your business. So first of those is our new producer builders. And for those of you that are just getting started with us or haven't started doing business with us, this is a great way for us to partner together. As you can see here, these are point levels. And so life insurance as well as annuity production and single premium life insurance for that matter as well, all qualify for this. And so you can see at different point levels, there are different things that you can qualify for. And so it's a great way to get started, get some production, see how good our service is, and also get some additional things that can help with your marketing. Now, one thing that I would mention to you is customization is a core pillar of who we are. And so if you're doing some things right now that are working well for you, reach out and talk to a sales director and chat with them about that. And we can certainly slot that in here for you if you'd like. Additional business builders that we have available. First off is our referred producer program. So if you're currently working with IAMS and like the service that we provide, and you know somebody that maybe isn't quite happy where they're at, send them our way. Not only will you get a $50 bonus when they get contracted, you'll get an additional $100 bonus when they place their first piece of business. And these are some of the biggest checks we cut, but on an ongoing basis, as they're producing business with us, you'll get checks on a quarterly basis off of their production. And so there's nothing that you need to do. We'll take care of all the service, we'll take care of the agent, but it's a great way to increase the revenues going into your company. Secondly, we've got our marketing reimbursement program. Again, this is a great way to double the size of your marketing budget. And so you can see there that for every 100,000 of annuity production, you get an additional $100 into your marketing account, and then $200 per 100,000 for single premium life, and $200 for 10,000 at target. So again, it's a great way to increase the size of your advertising budget. And that's one of the things that we've seen over the course of the last year is that you've got to be a little bit more creative with how you're marketing, and depending on where you're at, what you're trying to do, potentially invest a little bit more into your advertising to generate that consistent flow of prospects. Back office support. I think back office support has really been highlighted here over the course of the last year as carriers have taken staff remote. It has not been as easy to get business pushed through. And so having a good team of people at the IMO that you're working with who can help you from case design to new business processing to licensing, I think it's really put a spotlight on the importance of good support and having a really good back office. And I would tell you, we've got one of the best back offices in the country, but the best way to see that is to really experience it. And so for those agents that haven't gotten started working with us yet, reach out, talk to a sales director over here, and they can chat with you about that. As we know, things have certainly over the course of the last year gone virtual with virtual sales and the incorporation of technology to facilitate sales. Did want to make a point that we do integrate on our website with Firelight, so the ability to do e-applications on the annuity side as well as on the life insurance side. We've got all the software that you need to be able to transact business. And you can see here, we've got a number of carriers on here, and we've also got several carriers that we're in the process of adding on. So again, it's one of those things where we really do have our finger on the pulse of technology, and we're making sure that we're bringing things to the table to help facilitate doing business and to make it easier for you. Creative marketing solutions. That's probably been one of the biggest things we've seen over the course of the last year as different areas, different states, different cities, different towns are all over the course of last year have been at various stages of shutdown or open or what have you. And so a lot of the things that agents and advisors did marketing wise pre-COVID have had to been modified or tweaked or maybe even set to the wayside. And so one of the things that we've had to do over the last year is get a lot more creative with marketing and really drill down and get a good sense of what's going on in an agent's local marketplace. And so one of the things I would mention to everybody on the call today is we do offer a custom marketing analysis. And what that entails is taking a deep dive into your business, looking at how you're currently marketing, what your target market is, what are the marketing assets that you have, and then crafting a customized marketing plan based off of that to where we come back and show you, here's the different things that we think make sense. Here's the prospect flow we think it generates, and here's the price points and the ROI. And so I would encourage you, if you haven't taken advantage of this complimentary service, reach out, talk to a sales director and chat with them about it. They'll be more than happy to help you with it. And again, I think it provides a lot of clarity for the advisor with what makes the most sense in their marketing. The IAMS website, as I mentioned with Firelight, there's a ton of resources on there from Firelight, iPipeline as well on the life insurance side. We've got life insurance quoters, annuity quoters. You can get access to rates. You can download forms if you're doing a paper application. You can see current updates and industry news. And then we've also got our sales resource library, which is, I think, a huge opportunity for advisors out there. Whether you're meeting prospects face-to-face or virtually, we've got literally hundreds of point of sale pieces that are unbranded that you can utilize on basically any concept under the sun that you'd want to talk about, from life insurance or annuity basics and how do those work to getting into split dollar and premium finance. And so you'll find that there. You just have to be a licensed agent with us and be registered on the site, which if you have questions about that, as you would imagine, reach out to your sales director and they can help you with that. Retirement Analyzer is a software platform that we use that you can actually get access to through IAMS at no cost to yourself, but it does a very effective job of helping people with one of the biggest fears people have when it comes to retirement, which is, am I going to outlive my income in retirement? And so in a very simple and straightforward manner, it can articulate whether they're on pace or they're not. And if they're not on pace or haven't planned properly, what the right solution is. And so it works very, very well face-to-face. It's also, again, because of the simplistic format of it, works very, very well with virtual presentations. IAMS Wealth Management. Right now, in my opinion, there's never been a better time. We talked about the Department of Labor rule here the last couple of weeks, and while you don't need to have your 65 to be in compliance, right now is a great time if you're looking at expanding your business and wanting to gather assets to look at this. Charles and his team do a great job. Or if you're maybe not quite happy with your current relationship, reach out, talk to them. They'll go into who IAMS Wealth Management is, how they can help, and the services that they provide. Last but certainly not least, wanted to make a plug on our Top Producer Summit. This is going to be truly an experience of a lifetime. It's a Mediterranean cruise. You can see there we're going to be going around the boot of Italy and getting to see a lot of different places. Qualification has already started, but you actually have through June 30th of next year to qualify, and it only takes 4.5 million points. I would encourage you to reach out, talk to a sales director. They can get you some more information on how to qualify for it. We also have a banner on our website, but it really is going to be a great experience, a great opportunity, and we're really excited to get back to doing these types of events. So this will be end of August, beginning of September next year. But again, I would encourage everyone to reach out, talk to a sales director, and they can give you some more information on that. So with that, we'll go ahead and get into the main stage of our presentation. With us today, we've got John Salomon. He's the owner and founder of Optima Financial. And quite frankly, I've had the pleasure of working with John for over a decade now. And I can tell you he's one of the most knowledgeable people I've ever met. when it comes to the life insurance space, and especially in the index universal life marketplace. And so when we saw that legislation passed and we saw what the opportunity was in the marketplace, I couldn't have thought of a better person to have be a part of this webinar series. And so he's going to be with us on this presentation, the next two. It's going to be a three-part series called the IUL Advantage. And he's going to be really walking us through what's going on, what the opportunity is, and sharing a lot of really great ideas from how you phrase things, how you position things, how you design these products. And so we're really excited to have him on here, and he's going to kind of pull back the curtain and share a lot of really great ideas. So John, appreciate you taking the time with us this morning.
Thank you, Curtis. Do I sound okay?
Yep.
All right. I got to tell you, you're killing me with putting that cruise up. That was literally the exact same cruise I was supposed to go on with my family in June. And I was, we've all got all kinds of horror stories. My kid's a senior in high school. He's missing his whole senior in high school, but that one just hit me in the heart a little bit. So thanks for sharing, buddy.
Well, that's part of why we scheduled it for the latter part of next year. We're very confident we should be able to get that knocked out and go on it. So.
Well, there you go. Well, thank you for the nice introduction. Welcome, everybody. I hope I can live up to about a third of what Curtis just mentioned. And it's interesting when he mentions all those things I'm going to cover, and it is over the next the next two webinars plus this one that'll be covering all those things. And this one's kind of interesting because of what Curtis mentioned, the legislation changes and what's happening. This is kind of an amalgamation of several different presentations where I'm going to talk a little bit about some objections. I'm going to talk about some insurance tidbits. I'm going to talk about, what's happening with 7702, what did happen with AG 49, and what is happening with AG 49A. I'll get through all those things over the next three sessions. And I'll get into some opportunities for you guys to ask some questions and maybe let Curtis know what you'd like to, dive in a little deeper. With that, let's jump into this. And I always start my presentations, and for those of you, you'll see this slide several times. It doesn't matter to me what you're selling. If you're selling life, annuity, disability, or widgets, you need some kind of an elevator speech to get going with people. And I just love these three things to share with you because it's kind of an idea on what we can do to introduce ourselves for what we do. These three things may sound kind of cheesy, but you need to work your own personality into them. And I like the first one a lot. I fix broken insurance portfolios. It's a fancy way to say I'm a life insurance guy. Or you can say something along the lines, I sell, do you have the old kind or the new kind of insurance? Some kind of an amalgamation of those words talking about the chronic and critical illness riders. Do you have the old kind of insurance that doesn't cover you for chronic illness or critical illness? Figure out how to work those words into your elevator speech. And the last one here, I sell life insurance, not the kind you've ever seen. Does your life insurance, get you invested into the stock market with no risk? We all understand the high water parts of these things, the annual reset and lock-in. I just like being able to explain that in a very succinct sentence. So figure out a way to say that. And then you can also throw something along the lines of, I like to protect my clients from Wall Street, DC, and the insurance industry. I'll talk about that in a little bit. But there's a lot of things that I like to talk about specifically with guys that are in the annuity world, producers in the annuity world, any advisors that are in that side, just because so much has changed. And I hear this a lot because, I deal with tons and tons of agents. And many won't sell life insurance simply because of the underwriting process. And if you take a look specifically what's changed in the last year because of COVID and the underwriting procedures, and we've brought in LexisNexis and TransUnion and all these amazing ways to get things done. And I will go off on a little tangent here and mention a product that's coming very soon. There's a new IUL coming to the marketplace that you'll all have access to. It's going to have limited distribution and instant access to the policy, and it will be one of the best illustrating, best performing products on the street with immediate underwriting. So stay tuned on that one. I'll probably introduce that one in the next call. I always throw this date out January 1st, 2009, simply because that was the day we switched from the 1980 to the 2001 CSO table. What does that mean? Well, anyone that has a policy specifically purchased before January 1st, 2009 is on a 1980 CSO table. And I always mention that because any old whole life policies, if they're still insurable, are ripe for 1035. Tons more on that. Just keep that in mind. That's a whole conversation in and of itself. Contingent beneficiary referral, I like to throw this out because I literally built my career on it. Every application you ever do, they always say beneficiary, but there's also a contingent beneficiary. Very few people talk about that. The contingent beneficiary is usually someone very close to them. It's usually a brother, sister, parent, best friend, someone that they know they can get a referral to. Think about your own personal life insurance policy. Your beneficiary is probably your spouse, but who's a contingent beneficiary? It's someone you know, love, and trust that you could get me an appointment with. Great opportunity to get in front of more people. Now I want to kind of just dive into some of what I just call tidbits. I added this fifth one here. What happened to universal life in the 90s? And everyone always bitches about, it just blew up. It was the worst product in the world. Whole life guys say that all the time. So I want to just start with one thing that drives me insane in the industry. If you think about how all these policies were sold. And what happened was interest rates were high, but nobody, and here's the key, nobody in the 90s was max funding universal life. I went and bought a whole life policy myself back in 1992. And this is the illustration from it. And what's crazy about this is if you look at the illustrated cash value, and we are right here in year 28 right now, and take a look at what I'm supposed to have in cash and what I'm supposed to have in death benefit. And I'll show you the next slide. We're supposed to have 117 in cash and 285 in death benefit. And what do we have? Less than half the death benefit and significantly less cash value. So when people talk about universal life blowing up in the 90s, I lose my mind because when I bought this policy, had I put the same amount of premium into a UL, I would have significantly more cash today. And that's just one thing I want you all to think about whenever you talk to somebody that is introducing the concept of universal life stinks because of what happened in the 90s. And it's just so backwards. No one understands that, hey, I ran the #1 branch in MetLife back then. And we had west of the Mississippi, I should say, it was #2 in the country. We had the ability to sell these things max funded. Never did we. We put an extra 10%, maybe 20%, never showed option B max funded. But that was the big issue with it. If you want to hear more about that, let IAMS know. We can chat more detail about that. But I just thought that's an interesting tidbit to understand. Let's talk about index universal life. As I mentioned before, it does an amazing job of protecting you from Wall Street. So you'll never have a losing year. Protects you from the IRS because it's tax deferred with the potential tax-free loans. And we have this opportunity for the chronic and critical index riders. And I threw this out there the second time just to specifically say not long-term care. I hate when I hear people talk about chronic illness riders as long-term care. So let's jump a little bit into what's happening in the world right now and what happened back last year. A bunch of things happened last year. We had the introduction of the 2017 CSO table. So think about what I said a minute ago. January 1st, going back anything from January 1st, 2009 before was a 1980 table. Then we went to the 2001. Now we're on a 2017 table. So specifically today, those policies are significantly cheaper than those old whole life policies. And I want to cover all these bullet points just because it's really important for me to understand what's really happening in the world right now. There's a changing environment in the IULs. It's not just a retrofit. We have AG49, we have AG49A, and we recently had 7702 thrown at us. So let me just kind of walk through this a little bit, and I'm going to get into a lot of detail on our next presentation. But for this one, let me just give you some highlights. The intentions of AG49 were to levelize the playing field, so to speak. But what ended up happening, and I'll get into this with a few slides, was there was a significant difference between the illustrated rate and the crediting rate. The illustrated rate being the number you see at the top of the page, and the crediting rate being the numbers you see crediting to the actual policy. Gigantic difference. I'll get into that in a minute. But the consequences of AG49 were significant. Because of what happened, we saw some pretty ridiculous, I'm going to say illegitimate opportunities for the actuaries to get very, very sharp and throw some things out there that very few people understood. And of course, how that would have been affected in the policies with the sequence of returns is really important. So these are just some bullet points of the things that we'll cover. That was more for me to remember what we're going to do with them. But I like to say this, when you're talking about specific products, does your marketer know why they're recommending the IUL that you're selling? Whatever IMO you're with, do they really know why they're selling it? And I hope it's not simply because of the illustration. And are you selling them properly structured? I'm going to get into this, but this is one of my favorite lines to make sure everybody understands. There's not a tremendous difference between the number 1 product and the number 5 product on the market, but a poor product designed the right way is way better than the best product poorly designed. What do I mean by that? Think about the best product out there, illustrated, level death benefit at target, versus the number 5 product out there, max funded option B. Obviously, the latter is significantly better. And with that in mind, do you understand the inner workings and all the moving mechanisms inside these policies? And it's very hard for anyone to understand that. You can't even come to any meaningful conclusions nowadays when you read the agent's guide, when you read the actual policy, when you read the illustration. I wish we were in a room right now, because my favorite question to ask is, hey, how many of you have actually read an illustration, read the agent's guide, and actually read the policy? It's really important. And it's hard for me to get up here and say, hey, illustrations are important, but they almost mean nothing. It's very difficult for you to compare 2 illustrations and come to any meaningful conclusion. It's even more difficult for you to look at 2 illustrations and one that has better numbers on it, and for me to convince you that that's literally not the best policy, because all these regulations, this AG 49, AG 49A, what's happening? They're simply illustration regulations. So again, do you want the best product or the best illustration? My goal is to give you something to ponder, and when you're actually looking at these policies, and think a little deeper about what you're selling and why you're selling. I will get into AG 49, a little bit more into 7702 and AG 49A, but again, that'll be the subject of the next call. One thing I really want everyone to come away from this call understanding is which carriers have advantages in times like these, when the VIX is up, the VIX is down, the interest rates are low. We don't have as much of an option budget, and options are more expensive. And hopefully everybody's heard the term risk premium. What is risk premium? Risk premium, what it literally means is, how do these insurance companies that have a general account of 4% go to the market with that 4% and turn it into 6, right? That 2% risk premium. How do they do that? And I want to talk about how different companies do that and make sure you guys understand that. But first, I want to say we get calls almost daily talking about these different products, right? This one's got the highest cap. This one, in this giant study that was just done, there's 210 cells. It was number 1 in 187 cells. This one's got the best accumulation. It can be BS. It doesn't matter what their loans, what the distributions are, what the triggers are. The whole point of this slide is just to say there's not any one part of any index life that makes it better than anything else. And I'm going to say there is an exception to that right now. There's a big exception to that, and it's called the auto lock feature. And I'll talk about that in a little bit. But, in January 1st of 2020, all the new products came onto this new 2017 CSO table, and they were constantly hitting the street, and they're coming up with all these different ways to make them look better. But, if you have a look at AG 49, and read what it said, it was just a couple of pages of well-spaced text, and everybody got very creative, which is why we have AG 49A now. Again, do you want the best product or the best illustration? You have to understand what I mean by that by the end of this call. If not, start asking some questions. And again, the whole point of this slide is just to say there's not any one part of any index life policy that makes it better than anything else. Let me just share with you real quick what happened with AG 49. We had the new 2017 table come out last year, and then AG 49 was upgraded. For the protection-focused products, it was a really good thing to have the new mortality table, right? But it wasn't so great for the accumulation-focused products, because we had to buy more insurance for these solves. What's interesting to me, if you take a look what actually happened with AG 49 during all this, and this is the part that I hope shocks everybody on this call. And if you guys have seen, Curtis and I do presentations before, you may have seen this slide, but I want to make sure everybody understands. And if we go back to pre-AG 49 and we talk about the illustrated rate, all right, I mentioned illustrated rate versus crediting rate. We used to illustrate at 8.43. Post-AG 49, we started illustrating at 6.85. Then what happened is the incomes, even though the illustrated rate went down, the incomes went from 70,000 to 84,000. And by the way, at the same time, the average charge went up. How does it make sense? The illustrated rate went down, the income went up, and the fees went up. And that's the whole issue that we're all dealing with. So let's talk, how do you compare policies nowadays, right? How does someone pick up two policies and compare them? And let me just go back in time and think about a regular universal life policy. With the guy 40, he's going to pay $10,000 in for 20 years. Let's think 20 years because it's beyond surrender charges. All things being equal, think regular universal life. All things equal, male 40 preferred two different companies. Company A versus Company B. Well, Company B with 727 obviously has smaller fees than Company A because everything's being equal. This is a regular universal life policy. And it's not like that anymore. What changed? Something happened, right? AG 49 came in and really changed the landscape of what we're doing. Again, I mentioned a second ago, how many of you actually read an agent's guide, a contract, or a policy? We all want to do what's best for our client. If we put the client first, the life insurance carrier second, and ourselves third, we're going to be way better off down the road. Who out there thinks they can read two illustrations and really compare them? It's to the point now with AG 49A, and we'll see what happens with 7702, that you're going to be illustrating a bucket, an opportunity inside the index life policy. This is my new 2021 phrase, practically guaranteed to not be the best performing bucket, if you will. You can go pick something that has a bonus on it, but that bonus will give some opportunity cost, throw out the door and say, hey, if I didn't take that bonus, I could put that money towards better caps and potentially do better. In other words, it's just very difficult nowadays that we have to sell illustrations and use the illustration in a way that we know won't perform best in the long run. And more on that in our next presentation. But it wasn't about that long ago we could read all these things and come to some kind of a conclusion as to which policy is better. But today, again, it's very difficult to read two illustrations and come to any type of a conclusion as to which one's better. And again, think about what happened with AG 49. It was developed to standardize illustrations. But what the problem was, I was consistently seeing 13, 14, 15% distributions. I've even seen these guys out there, I'll pick on the two companies, Mutual Omaha and PAC. You've all seen some of the issues that PAC's had and some of the lawsuits. But what's insane to me is that when these two carriers allow this thing called hyperfunding, putting money in, taking it out, simply leveraging loans inside an illustration, even with AG 49A, with only a 50 BIP arbitrage opportunity, it still works. And I see those types of things and it drives me crazy. Let's talk about the four things that really happen with AG 49 and why these hyperfunding type things work. I'll get into these in some big detail in our next presentation, but the four issues that really came to play were here. The idea of multipliers, and what's a multiplier? Think about above a 100% participation rate. We had a max loan arbitrage set at 1%. Not one single company held to that. We had this new introduction of guaranteed bonuses, which circumvented the entire intent of AG 49. And of course, the max illustrated rate was nowhere near the max crediting rate. I will get into that in a lot more detail because it'll make more sense when I put it all together for you. But just to share what really kind of went down in a little bit, just to share what went, go through what I'm going to go in the next presentation. Take a look at two policies. One has a 12% cap and one has a 10% cap with a 7% bonus. You could assume a 5% loan. And AG 49 is interpreted in many ways, so it comes down to the crediting rate and the illustrated rate. I like to say what they are and what they are not. It's an oversimplification, but the illustrated rate is really the number at the top of the page, and the crediting rate is the all-encompassing total return. If you have a 12% cap, you're going to get a 6.96% illustrated rate. If you have a 10% cap, you get 6.09. But a 10% cap with a 1.15 bonus gets you 7%. So both of these are going to illustrate at 7%. But if you have a loan of 5%, this the one that has the bonus will give you a significantly bigger arbitrage. And I've got 4 or 5 slides, but I want to just throw this out there to talk about some of the games that were played and why we are where we are. And just think about it. Even though these two both illustrate at 7, the bonus allows us to blow past the 1% arbitrage. And I'll get into that, and that's why we still get up into the 12 and 13% distributions. It's the idea of just simplifying and reeling things in. It did not work. Actuaries went nuts. Some went over the edge, and we'll get into that big time next time. Here's all the IUL carriers that are in the marketplace. Here's some that we really thought through the whole idea of zero is your hero out the window. They had high rates, high reward opportunities, but very few people understood how they worked. These are some of the companies that I think they know what they're doing. They know what they're doing. And what's interesting to me when you look at this slide, and I just thought of this as I'm looking at it, what are these companies? You know, and I have a slide that actually says this coming up, I think. These 4 companies aren't life companies. They're annuity companies. That's really important. These 2 are very interesting when it comes to getting the accumulation slash death benefit sale. And I'm not making this a big product presentation simply because I don't get into product names very much when I do presentations, and I'll show you why. You know, we're here to earn your business. Curtis and I are trying to educate you guys, show you that we know what's going on over here, and get IAMS the opportunity to take a crack at some of your business. So if you look specifically at this slide, I feel kind of cheesy, but I don't like giving out the names of the companies simply because I look at how many of you are listening to us right now. You're just going to go to your FMO and say, hey, I heard this, can we do that? Well, that's not fair to us if we give you all the information. So the idea is to get you guys excited enough to make the phone calls, reach out. You're going to all hear from IAMS after the call and ask the questions, and let's go through. I'm happy to share the information with everybody and tell them what the companies are, but we want the opportunity to show you what's happening. So here are some of the examples of how carriers, you know, responded to AG 49. Think about that first slide, second slide, I think it was, when I was talking about, hey, you know, what really happened to the industry when illustrated rates went down, fees went up, and distributions went up. That just doesn't make any sense. And then think about the other one where I was talking about, you know, there's not any one moving part that makes any product better than anybody else. But think this, these are the numbers I threw at you earlier in an earlier slide. I just took this 8.43 and the 6.85. We had 2015 and 2020. We dropped from 8.5 to 6 3/4. At that same time, our income went from 70,000 to 84,000. These are the same numbers I showed you. And think about this. The charges went from 72 to an average of 202. Obviously, the 202 is huge because there's some outliers here. But one of the top selling policies in the market is B. And think about this. 25,000 for 20 years. That's 500,000. The fees are more than the premium. The fees are a huge percentage of the premium. These are the ones that we're really selling. Does that make sense? You know, if you think about having those fees, doesn't illustrating at a high rate really make these policies sing? Yes, but what happens if you lower the illustrated rate on some of these policies? In fact, that's my next slide. If we go out there and we went from 8.43 to 6.85, think about what happens if we drop that 6.85 down. And I love this slide. If you take those top companies and we show their illustrated rate, if we drop those illustrated rates by 30%, distributions drop by 80%. The next company dropped by 70%, 44%. You get the idea. The max rate versus 70% of the rate is a huge reduction simply because of those fees, okay? And a lot of those companies did some pretty crazy things. They were designed with huge fees, but what happens to those? Will a bad year really affect those? Absolutely. But think about how you're designing the products and the ones that you've sold. If you're selling level death benefit, you had a 3-pay, a 5-pay, or 7-pay. A 0 will really hurt those policies. 0 is not your hero because of those additional fees. 0 is not your hero specifically in those shorter 3-pays and 5-pays. What I like is the longer pays because the more premium you get in and the longer you pay, the lower the death benefit, the smaller the corridor, the smaller the fees. If I take a look at some of those top selling IULs last year, I get worried because of the multipliers, because of the 13, 14, 15% distributions that were shown. Again, do you guys want to do the best product or do you want to have the best illustration? Very, very different. My favorite line, I've been saying guarantees are expensive and risk is free forever. But again, in today's world, my new line is practically guaranteed because of AG 49A. Our illustrations were reeled into the point where I really feel that the likelihood of success is so high that we're, quote, practically guaranteed to make those things come to fruition. All right. Do certain companies have an advantage? What's the primary business of those companies? That's what I mentioned a minute ago when I put those companies up, those 4 companies. When I go to their company meetings, I'm literally the redheaded stepchild in there because I'm the life guy. And there's a few things I just want you to think about when it comes to picking companies and how they're going to weather the storm of low interest rates, market volatility, which leads to higher option costs. And think about a couple of things. Does the company that you work with, do they hedge internally? I'm going to talk about static hedging and some dynamic hedging in a minute here. But, do they trade billions of dollars a day, billions of dollars a couple of times a day? Do they have their own efficiencies? Do they invent several of the hedging techniques they use? There's one company that literally created the monthly sum. They created the blended index. They created something called the trigger. They created volatility controlled indices. They didn't create them. They brought them into life insurance. But they also brought in the index lock feature. And I'll talk about that quite a bit in our next call. But what I like to say is understanding what these carriers do and how they do it is really important. And when I look at some of the better illustrating products post AG 49, I think, well, these guys are paying someone else to hedge. They don't have the expertise. How are they possibly going to maintain the promise to you guys and to your customers simply because this is the ultimate trust me product? And I'll get into that a little bit more. But, why did we get volatility control indices into universal life policies? Think about that. They're always looking for ways to improve returns. And with interest rates down and option prices going up, the 1 year point to points are just getting too expensive. I'll show you a slide in a minute here where literally if a company has 4 versus 4.25 to go to market with, that 25 bips is the difference between a 10 and 11% cap. So they wanted to get some upside potential at a lower cost. And the VCIs looked great. What's interesting to me is when I think about how many 150 point days, swings in the market did we see 10 years ago, 5 years ago, the last week, right? Things are crazy. And I haven't updated this slide. 2019, these VCIs did 15 to 30% in the life insurance policy. Not as great through December of 20, but depending on the year, they did fantastic. Hence, dollar cost averaging makes sense. But let's talk about the potential with the VCIs and some of the issues that could happen. They're sold as the S&P with training wheels. And for those of you that don't understand what these are, we should probably do just a special 10 minutes on that. So if anybody has some questions on what VCIs are, we should probably just do a deep dive. I don't have time to do that today. So Curtis maybe should jot that one down. But what's interesting to me is the companies just in the last week, 2 companies rolled them out because they've been the hottest thing. And I think every carrier has to have them now. And if you've seen what's happened to the VIX, it's been as high as 80. I think I checked on Friday, it was at 28. But think about what happens. If the market volatility is crazy and the money shifts over to the bond side, what happens if the bond volatility really starts to crank? Yes, that sounds silly today, but back in March and April, it wasn't so silly to get scared of what was happening because that did happen. What if there's defaults on the bond side? Think about that. That's a little scary, but I don't want to get too deep into that. There are volatility controlled indices that do have a third leg, that have a cash account that can help minimize those risks though. And how do we minimize risk in the market, right? That's the most important thing to us. And I learned back in college, I have a degree in finance, and there's really only 2 things that help you minimize risk in the market. Everything you talk about comes under 2 bullet points: time and diversification. The secrets of returns, dollar cost averaging, all those different things all fall under the diversification model. But the whole idea for us is not to try to make 10, 12, 14%. What are we really trying to do with Index Life? We're trying to get our clients a reasonable rate of return, maybe a step up from the bond-like portion of our portfolio. And sequence of returns is really important to make sure that we hit those numbers that we're illustrating. And what do I mean by that? If you just take a look at what's happened in the marketplace and how people diversify in their policies. If you take a look, if you put all your money in the S&P 500, over time, we would have struck out quite a bit. We would have struck out 23 times. In other words, we would have got a 0. But we also would have had a bunch of home runs, right? We would be knocking it out of the park 40% of the time. But what's crazy to me, if you take a look at what happens versus diversifying versus putting the money in the S&P 500, the diversified rate goes up, and we get rid of a lot of the zeros, and we get rid of a lot of the grand slams, but we hit a lot of doubles and triples for a better score. So think about that. Let me just explain what I mean by sequence of returns, how important it is. If you take a look at this gentleman, 45, 25,000 for 10 years, increasing death benefit, loans at 65. I'm going to show you what happens if we have the rate of return set at 5.5, 6, and 6.5. Then I want to run the same average rate of returns, 5.5, 6, and 6.5, with a 0 every 5 years. And if we do that, I think this will shock you. If we do that exact same illustration with a 5.5% illustrated rate, our distributions are 37,307. If we get a 0 every 5 years, it'll blow up at age 90. That to me is a little mind-boggling. And if you take a look at the 6%, we can pull out 48,000 just by raising 5.5 to 6%. We can pull 37,000 to 47. If we have a 0 every 5 years and still average 6%, it blows up at age 82. If we average 6.5%, it goes all the way. It goes to 54,000 to age 120. But if we get a 0 every 5 years and still average 6.5%, it goes to age 79. What's interesting to me is two things come to light when I look at this. If we simply take this 37,307 and drop it to 36,000 manually, we just go into the software, take 37,307 and just drop it a little bit. We're able to absorb zeros perfectly. But think about the inverse of that. This is really important. This is what drives me nuts about illustrations. What if we go into the illustration and I don't change anything except, hey, I'm just going to go manually pull 36,000 out. I can still show the zeros every 5 years, and it's going to go to 120. But think about what if I said, hey, computer, pull out 37,308. $1 more and this thing's going to blow up. These things are designed with these algorithms to take you right to the edge. Let's back it off a little bit. It's amazing. AG49A did that for us, but I love to show this because I want people to understand how to make the likelihood of success go up. Let's talk about some of the objections you get when we do these policies. If we take a look at from 1980 to 2019, the S&P with no dividends, the CAGR was 8.81. We always hear if we're illustrating, it's impossible to get 7. You know, there's a cap on it. Well, they're forgetting that CAGR includes the negative years. We're not going to have anything go negative. The other thing, I specifically say no dividends, because one of the objections I hear all the time is, well, you know, the whole life guys, the variable life guys say, you know, our options, they don't have dividends. That's true. But if we bought the options that included the dividends, our caps would be significantly lower. And this happens to be a better way to go for what we're trying to do. And then the other thing I hear all the time is, you know, companies can really lower caps. And let's talk about what caps are. Let's talk about rate of returns in these policies. Again, everything's driven by volatility. Higher volatility in the market means these options, the opportunity to go to market and buy the upside potential is more expensive. Interest rates are lower, so we have lower amounts. Our option budget's lower. Do the carriers control interest rates? Absolutely not. Do they control market volatility? No. Do they arbitrarily move caps? Well, the good ones aren't gonna. In fact, some of them, I love to tell this story. Again, you need to be with a company that's hedging themselves. You need to be with a company that does a ton of annuities. And you need to be a company that doesn't make the hedging, strategic or dynamic, a profit center. There's companies out there that say, look, we've got 4.22% to go to market with. If you spend 4.23 and give the client a little bit better return, no bonus for you. If you spend 4.21 and do a little bit better for us and the client gets a little less, no bonus. They have to market these. They have to invest in these opportunities to a revenue neutral position. To me, that is huge. You know, I want these companies to be involved in annuities, hedging internally, and making sure it's not a profit center to minimize the risk of arbitrarily playing with caps. Let's talk a little bit about strategic versus dynamic hedging. Think about strategic the static way. You know, you adjust for a specific period of time. You're just buying something. You're usually paying someone to go to market and do something very simple for you. The dynamic side is much more difficult. Frequently rebalancing, daily or more. Think volatility controlled indices. Think about all the different blended index strategies and what these things do for you. You know, static hedging, companies purchase assets from investment banks. They use someone else to do it for them. The dynamic hedging requires, you know, frequent adjustments. More often than not, it happens more often than daily, I guess I should say, as market prices change. And because of the expertise of these companies, the size they have, their hedging desks, they can do it much more cost effectively. And you need to know which companies do that, and you need to know which ones don't. And believe it or not, some of the companies with the best illustrations don't do that. Illustrations are nonsense. You want the best product or the best illustration. I stole this from one of our carriers. It was in their was in their brochure, their agent's guide, but I like it because it really explains things. Yes, it's oversimplified, but it really helps for all of you guys and gals on the phone to illustrate and discuss how hedging works, because we're not hedging, we are hedging, we're not investing. That's where the whole life people lose their mind. If these insurance companies only have 5% to go to market with, how are they getting 7? That's a 40% rate of return. Well, no, it's not a 40% rate of return because we're not investing. We're only hedging that 5%. What do I mean? So we have $10,000 premium. They take $9,500, they put it into their general account. $500 gets going towards the options, okay? So the idea is to have that $9,500 because of the money they're making on their fixed account grow back to $10,000 at the end of the year. So we have our $500 to trot off to market with. So let's just say we go off to market and we want to buy a call option on the S&P 500. That option is going to cost us $600. Remember, we have $500 to work with. If we go sell an option that starts at a 10%, a strike price higher than we are today, we're going to get $200 back. So that's only $400. Nope, we can do better than 10. If we go up a little higher, we get a 150 back. No, we're not quite at the 500. Hey, look at that, 12%. We can sell it for $100. We bought for 600. There's our $500. There's our 12% cap. Oversimplification, absolutely. A way to explain to your client how we're only using this 5% to get us there. It's hedging, not investing. Very important. Think about this. If we take a look at what these companies have done, the fixed accounts average with this particular opportunity of 4.21%, yet every one of their policies is illustrated almost 7%. That's the risk premium. How have they done it? They've done it very successfully by hedging, not investing, okay? So let's talk about the different types of products and how they work with this. You know, I've said for years that IUL can net you X after the fees, and it can be tax-free. X has changed over the years. I used to say we could literally, get 7% after all the fees, but we have a lot of issues out there in terms of markets and interest rates and things like that. But I like to think of it as a bond-like return with the kicker. Is that X now 4%? Is it 5%? X has changed, but so has all of the other opportunity costs for these same dollars. The core positioning of these dollars hasn't changed. The same money that we would put this money in, or the other opportunity, if you will, they've all changed. So the opportunity costs for these funds have all changed. What are the alternatives for these premiums? Do those alternatives have zero as your hero? Do they have annual reset and lock-in? How much would you put into an opportunity, an investment, whatever you want to call it, that can net you 5% after fees? The caveat, you need to have 15 years and be healthy, right? And it's not super liquid up front. It can be with the riders, but I just don't like people putting money into the next life that they're going to take out in the next 15 years. Can I make you an illustration looks good in 7? Can I make one looks good in 5? Absolutely. But a 0 destroys those, right? Let's not overpromise. Let's underpromise and overperform. Again, how much would you put into an opportunity that can net you 5% after fees, tax-free, that's going to protect you from Wall Street DC and your doctor bills? I like it. And how do we do that? Think about some of the advantages we've had with these dynamic hedgings. The companies that do this right, they're not relying on investment banks. We want the ones that are in-house and doing it more efficiently. They have to have the ability to do it. Innovative index allocations, expanded bonus options. These are the annuity companies that can do this. I've said that enough. I'm not going to keep going off on that, but I just think that's really important. And just think about the slide I had earlier where I said, hey, a poorly designed product, if it's a really good product, still doesn't keep up with a poor product that's designed the right way. And let me just explain a little more detail about that. You have a 45-year-old paying $30,000 for 10 years. And then at age 66, he's going to pull some money out. Let's just assume a 7% rate of return. So the outcome for this is his initial death benefit on level is $1.4 million. Okay, he can pull $70,000 a year out, and his target's $23,000. The next opportunity would be, hey, what if we design this the right way, and we use increasing death benefit? It started at 1.4 with level, it went down to 650 with increasing, and they can borrow $69,000 out of level, but they can borrow $84,000 out of increasing. Why would anybody sell level? Because the target premium's higher. Right? And if we go compare the target premiums, it went from 23,000 to 10, significantly lower. But look what you did to that client. the ignorant or greedy agent who sold the level death benefit, they made $13,000 more, but it cost the client $15,000 a year for 30 years or $450,000. I don't want to be a juror sitting in there during that lawsuit. This is why we have to understand the inner workings and the hidden mechanisms of these policies, and everybody understands how these things work. Quick little story, my wife was sitting getting her nails done, and this woman started talking to her about index life and why she should buy it for retirement. And so my wife bit and I got an illustration from her. And this woman showed her a $400 a month level death benefit at Target. I wrote all over it. The poor girl was mortified and quit what she was doing on the side for another part-time agency. But that's a fun story. Let's go here. Let me just talk about the reason some of these things illustrate the way they do. If you have a maximum non-MEC, right, and you're paying for 5 years, I can show you that the internal rate of return is 0.96 over 20, that the costs in these policies are less than 1%. How do we determine what the costs are? It's the internal rate of return subtracted from the illustrated rate. So in other words, if I'm illustrating at 6% and my internal rate of return is 5.04, I know that my total fees are 0.96. And I just have this slide here to show you some of the calculations that have been done. If you have a maximum illustrated policy paid for 5 years, I can get the internal rate of return down to less than 1%. If I pay for 7 years, I can drive it down lower, because by doing 7 years, I can start with a smaller death benefit. And if I pay just target premium for 10 years, my internal rate of return minus my illustrated rate is 2.5%. But it just doesn't make any sense when my total fees are that high. The idea is, if we do a maximum illustration where option B, maximum premium, minimum death benefit, I can show you that in 40 years, the total fees are 25 bips. The illustrated rate minus the internal rate of return is 25 bips. Very difficult to do when you look at some of these illustrations if you're using multipliers and bonuses, because the internal rate of return can literally be higher than the illustrated rate. That number goes negative. And what I really want to focus on is the option cost to get us to these very interesting fees. If we take a look, and this is what I was alluding to a minute ago, a 25 bip difference in opportunity to go to the market with is literally a 1% change in cap. So, I mean, if a company can all of a sudden find 25 bips more, they can do a much better job for your people. That's why these things are so tight, and you want to work with a company that's not making that a profit center. If all of a sudden someone decides they're going to keep a quarter or a half off the top, that's a 1 to 2% cap difference. That makes a giant difference. Let's just talk about a little bit some of the things I want to wrap up with on these returns, because the risk spread opportunity cost is the same, for all these different opportunities. IUL returns the return profile is higher due to some risk, right? Whole life in UL, they don't have the opportunity to get a risk premium, so to speak. Guarantees are expensive and risk is free. Instead of paying out 4.25% to a UL, let's take that money and go to the market and fund it. And how do we optimize those? Well, they have to be max funded minimum death benefit to really make sure the risk spread works. Illustrations don't show the risk spread. The company's only making 4.25% and we're actually illustrating 6.25%. Why are they doing that? Hedging versus investing. Illustrations be in a context of this environment, what they're showing, right? We don't want to get people showing this illustration and comparing it to investing in something very aggressive, right? We also don't want people to compare it to a whole life or to a universal life and say, hey, I'm going to show my universal life at 4% and I'm only going to show IUL at 5%. That risk premium has been proven by every single carrier to be very close to 2%. Some higher, some a bit lower, but whatever they have as a rate of return is about 2, hence AG 49. And I'll get a little bit more into that on our next call. But let's just talk about loans and how we get money out of these policies, because Curtis wanted to discuss inner workings and hidden mechanisms, and I'll just roll through these loans. I know we're coming to the end of the time here. But when it comes to there's two very different types of loans. The standard loans, the fixed loans, if you will, there's two types. We have, the fixed loan and the wash loan. And it really comes down to timing on those things. If we want to talk about a standard loan versus a wash loan, they're the most conservative. Standard loans are typically in the first 10 years where you're paying 3% and they charge you something different. So you actually have a little bit of a fee. The wash loans are, hey, we're going to credit you 4%, we're going to charge you 4%. but you have to be careful on those because sometimes if they credit you up front and charge you at the end, or vice versa, there can be a little bit of a fee. But think about what they're doing. Why are these loans wash loans? Because if we call them withdrawals, they're taxable, okay? So let's just talk a little bit about standard versus preferred in some detail. Think about what happens when you have a standard loan. The carrier literally loans the money from the general account right to the client. In a standard loan, a lien is placed on the policy, and then the policy takes the money out of the investments, if you will, and moves the money into a fixed account. That's what happens in a standard loan, the wash loan, if you will. They're conservative, and they're the lowest income potential, and there's no arbitrage. You know, that's exactly what the whole life guys use. Let's talk about participating loans and how they work. You know, they have an opportunity to earn money on your money. They have the highest income potential. Some have a fixed rate, some have variable rate. We like the ones that have a fixed rate, although there is a company out there that has a variable rate with a super competitive guaranteed cap, and that's actually the best loan on the market. Now, how do these companies work? I mean, how do these loans work? A little bit different. The money still gives the money directly to the client. There's a lien placed on the policy. No money leaves the indexing account. It continues to earn interest. What does that mean? If you look at the illustrations, it will actually show you what happens. There's your $1 million loan, okay? If you look at the cash values here, there's the difference. There's the $1 million out and the fees. But what's interesting to me, if you have a 6% crediting rate, there's your 6% of the total cash value. You guys should show people, look, you've got the money. Here's your cash value. You made all this money on that cash value. I'm not going to go too much to you, but these loans work best. They are a little riskier. They show the best distributions. Again, guarantees are expensive and risk is free. To me, this is not super risky. They move up and down with the Moody's corporate bond yield, which was beginning of this month was 2.22. That's a heck of a rate to borrow from. And again, think of the caps on the opportunities in here. But again, there's an outlier out there when it comes to borrowing money. There's a company out there that'll say, we can borrow money at 2.22 and we're going to guarantee you it's never going to go more than 5%. So ask your marketers that you're working with about that. And what loan do you choose? You know, they both work very well. And think of it this way. The general rule of thumb for Wall Street is 4%. And when we use a wash loan, we can get 6%. And it's very conservative. The likelihood of success is through the roof. So you can think about that. It depends what the client wants. It depends what the client's risk tolerance is. And we have to be able to explain it to them and make sure that they're comfortable with it and make sure we understand what they're doing. Because, Curtis, I'm coming right up on my 50 minutes here. I think I'm going to just scoot. What does all this mean? You need to work with someone that gets it, right? The guys at IAMS truly, and girls, understand this, right? So the marketers supporting you now, think about the carriers you're working with now and the IMOs you're working with. They really understand how this all works. And I love to just throw this out. Can you run your own quotes? You heard Curtis talk at the beginning about the service. They want to. They will help you. They will do it. But I just think that you have to be able to run your own quotes. And I talk to many, many advisors that I'm shocked at how many people don't run their own quotes, which I'm fine with. But can you? What if you want to show someone on your laptop during an appointment, during a Zoom call? Show the clients the flexibility of these products is best done by changing the illustrations around. And the best ways to learn about the products are to read it, read the illustrations, read the agent's guide, read the contract, and run quotes. I've got 5 or 6 more slides, Curtis, but because we're at the end of time, I don't want people to start dropping off. So why don't we turn it back over to you?
Well, yeah, and John, I mean, a lot of really, really great material. So a couple of things here. So first off, we are recording this presentation. So make sure you reach out to your sales director over here and we can get you a copy of it because as you can tell, John's got a lot of really good information in his mind, a lot of good material that we covered. And we'll, again, this is the first of a 3-part series. So we're going to have additional information coming out on the next webinar, but definitely reach out to us. We'll get you a recording of this. We also have a Smart Wealth Accumulation Guide available for everybody on the call today. It's a really, really good consumer-facing piece that talks about risk and retirement and how Index Universal Life can be a good answer to some of the biggest expenses in retirement, which are healthcare and taxes. So our phone number is 800-255-5055. But reach out, give us a call, chat with one of the sales directors over here. More than happy to go through the presentation with you and answer any questions that you have. And John, I really appreciate you taking some time with us this morning. Again, really, really good stuff. And uh, I think you gave a lot of clarity to some of the things that go on behind the scenes with the carriers and how they structure these products. So I appreciate you spending some time with us this morning.
Yeah, I'm sorry it was an amalgamation, and I realized the flow wasn't so great. But when I tried to combine 4 or 5 presentations down into one and make sure I hit my 50 minutes, I got close.
Well, I think you did a good job. And again, to everybody, give us a call. Team over here is happy to chat with you about it. Phone number is 800-255-5055. Thanks.